This week, the story isn't just what's happening in the economy, it's how expectations are shifting around it. First, on growth. Despite all the noise, the data still points to a steady backdrop. GDP tracking around 2%, and underlying demand remains intact, led by consumer spending and business investment. Second, inflation is where things get a little more complicated. Recent data shows price pressures picking back up, with core PCE running closer to 3% year over year. And when you layer in higher energy prices, it's creating uncertainty about how quickly inflation can move lower. That's showing up in policy expectations. Just a few weeks ago, markets were focused on rate cuts. Now, those expectations have shifted meaningfully, with the Fed signaling patience as it waits for more clarity. And finally, the labor market continues to do what it's been doing, cooling but not cracking. Jobless claims remain low, and companies are still hesitant to let workers go, even as hiring slows. So when you put it all together, the economy itself hasn't changed dramatically, but expectations have. That's important because markets tend to react more to changes in expectations than to the data itself. The takeaway, we're still in a normalization environment, not a downturn, but one where shifting expectations can create volatility along the way. And that's exactly where staying disciplined and focused on long-term positioning matters most. Thanks for tuning in. We'll see you next week with more insights.